Number two, we have ratio analysis. So when talk about the ratio analysis, as the name suggests, this is basically a tool of analyzing the financial statements, and it involves computation of ratios. Or this tool entails computation of what we refer to as the financial ratios. What is a financial ratio? This is basically a relationship between two or more financial variables. For example, in this case, as a financial analyst, you can express the profit reported by the company, or maybe the net profit or the operating profit, as a percentage of the company's revenue. So whatever you get, which automatically will be a percentage, is a financial ratio. And basically it shows the relationship between the operating profit or the net profit with the company's what? Revenue. So therefore you can say financial ratios is the relationship between two or more financial variables. Financial variables are those items which are included in the income statement, items of revenue, expenses, asset, liabilities, or what? Equity. Now, we have various ways in terms of these particular ratios may be used by various users. So therefore, you can look on the uses of ratios. Or uses of financial ratios. And even before you look on these uses of the ratios, it is important here to note that we have around 5 categories of ratios which may be computed using the information in the income statement and the statement of financial position. We have the profitability ratios, liquidity ratios, efficiency or activity ratios. We also have the solvency or capital structure ratios and the investment ratio. So therefore, what we are going to do here, we are going to look on what is the uses of those 5 categories of ratios. So let's start by looking on the uses of the profitability ratios. Now, these particular ratios here are used in terms of measuring the performance of the company's management, because in this case we say that if the company is performing well, then that is as a result of the good performance of what? The company's what? Management. So therefore these ratios we can say they measures performance of company's management. If a company is performing well, we have said that will be as a result of the good performance of the management. If the company is not is performing poorly, that we can also say it is as a result of the performance of a company's management. Then we also have the other category of ratios, and that is liquidity ratios. So how do we use these particular ratios, or how are these particular ratios used? Liquidity ratios, these are ratios which are computed. We're going to look on various types of liquidity ratios, and they are used to do what? To measure the ability of the company to meet the short-term financial obligations as and when they fall due. These ratios are computed to determine whether the company will be in a position to pay the short-term debts as and when they fall what? Due. So therefore this one measures ability of a company to pay, or in other terms we can talk of to meet short-term financial obligations. Short-term financial obligations. So will a company be in a position to pay the short-term financial obligations as and when they fall due. Short-term financial obligations, basically we are talking of payment which are supposed to be made to the creditors and basically the other who suppliers. So the company will need to compute now the liquidity liquidity ratios. So then from there we have the other category of ratios. So number 3, we have the efficiency stroke activity ratios. And these ratios, on the other hand, are computed to determine how well or how efficient the company is using its assets or its resources to generate revenue or basically to generate profit. So we can say the emissions, the efficiency, basically efficiency, we are talking of how well the efficiency of a company in using its assets to generate a profit. How well is the company using its assets to generate what? Revenue. And then the other category of ratios is the solvency through capital structure ratios. Now these ratios, on the other hand, are computed to determine the ability of the company to pay or to settle the long-term debts as and when they fall due. They measure the ability of a company, to meet long-term financial obligations. So these ratios are computed to determine whether the company will be in a position to do what? To pay the long-term financial obligations, e.g. the loans which have been acquired by the bank as and when those particular loans fall due. Then we have the last category of ratios, and that is the investment ratios. They are also known as the equity ratios. Now these ratios are computed to help the shareholders of the company, or basically to help the equity shareholders of the company in terms of doing what? In terms of evaluating how well the investment in the company is performing. As a shareholder, once you invest there by buying shares, you want to know how well your investment is performing. So therefore we can say the help equity shareholders to evaluate performance of the investment. Evaluate performance of the investment. So therefore we have those as the 5 category of ratios, and basically the uses. Okay, so then from there we need to proceed and look on what are the limitations of ratios before we can look on the various ratios which are computed under each of these categories here. We can first of all look on what are the limitations, or what are some of the shortcomings of the ratio analysis. So let's look on the shortcomings. Limitations of ratios. And basically here we have various shortcomings. We have various limitations associated with the ratios. Number one we say that ratios are historical in nature. Ratios are historical in nature. Historical in nature. So historical in nature means what? It means that when a financial analyst is computing ratios, ratios are always computed based on the past data. And therefore, if the circumstances have changed, then those particular ratios cannot be used in terms of making what? Decisions about the future. That is one of the limitation. Number two, we say ratios ignores the time value of money. Ignores time value of money. Ignores time value of money. So ratios do not have any consideration as far as the time value of money is concerned. If the company, for example, acquired an asset some time back, like 3 years back, maybe at a cost of 2 million, when computing the ratios, we use that amount of 2 million. I will basically use that figure of 2 million. So despite now 2 million currently not having the same value as 3 years what back. So the ratios here totally ignore the time value of what? Of money. On the other hand, we say ratios also ignores inflation. Also ignores what? Inflation. Ratios do not have any consideration as far as the changes in the prices of goods and services is concerned. Number 4 is that ratios ignores a qualitative aspect. Ratios ignores the qualitative aspect. So basically what that means is that the information which is provided after computing the ratios is purely quantitative. Ratios provide information about profitability, about efficiency, about now and that is profitability, liquidity, and efficiency. That is a quantitative information about the company. But ratios which have been computed, they do not provide any information about the qualitative aspect of the company. When talk about the qualitative aspect of the company, we are talking of aspects such as customer satisfaction. We are talking of aspects such as what? Maybe the quality of a product and also the services. We're also talking of maybe the quality of management. So the ratios computed, they do not give any information about all those quantitative all those qualitative aspects. That is the other limitation of what? Of ratios. On the other hand, number 5, we say ratios are subjective. Ratios are subjective. So basically what that means is that the ratios computed by each company will be affected by the accounting policies which a company adopt in terms of preparing financial statement. When we talk about accounting policies, we are talking of things like methods of depreciation. So basically what that means is that assuming you have two companies within the same industry, company A and company B, and you want, for example, to compare the performance of these two companies, and therefore you have computed similar ratios of the two companies. Now, if these two companies, company A, company B, happen to be using different accounting policies, like company A is depreciating its asset using straight line method, company B is using the reducing balance method, then the ratios which you are going to compute will be highly affected, will be highly influenced by the accounting policies adopted by this company. So mean that you may not be in a position to use those particular ratios to compare the performance of the two companies due to the fact that they are using different accounting policies. That's why we are saying ratios are what? Subjective. They are highly influenced by what? By the accounting policies which are basically adopted by different entities. So therefore, these are basically some of the limitations which are associated with this particular tool or this particular technique of analyzing financial statement. These are very, very common question, particularly in this paper called FRA. So therefore, you have to recall those particular limitations of of ratios. So next, I want us to look on the various categories of ratios which are computed, and actually the ratios which are computed under each of the category. So we start with the profitability ratios. So these are categories of ratios. Category of ratios. So let's just go straight to the first category, and that is profitability. Profitability ratios. Remember, in this case, we have already said that profitability ratios are the ratios computed to evaluate the performance of the company's management. Because you have said that if the company is performing well by the end of the day, that is attributed by a good performance of the management team. If the company is not performing well, then we can say that that is equally due to what? To the poor performance of the management team. So which are some of the profitability ratios which may be computed? So we can say these ratios include So, and what is important as far as these particular ratios are concerned is to remember the formula, because without remembering the formula, then you can't be able to tackle any question on ratios. So we have the first ratio here, or the first profitability ratio, which is known as the return on capital employed. Return on capital employed, abbreviated as ROCE. So how do we compute this? This one is computed by taking the profit before interest and tax, which is also known as operating profit. Operating profit. We divide that with the capital employed. Capital employed. And because this is a profitability ratio, by the end of the day, we express it as a percentage. So what is capital employed? Capital employed. So capital employed, we can abbreviate that as CE, capital employed. This one is computed by taking the total asset of the company minus current liabilities, or you can compute the capital employed by taking total equity. Total equity is the ordinary share capital plus reserves plus non-current liabilities. It is important for you to remember those two formulas, because the formula which you use, it always depends with the information the examiner has given you. So the other profitability ratio is what we refer to as the gross profit markup. Gross profit markup. This one is computed by taking the gross profit of the company divided by the cost of sales times 100. Number 3, we have gross profit margin. Gross profit margin. Anytime you see the word margin, as far as the computation of these ratios is concerned, the denominator is always revenue. Anytime you have seen the word margin, and then the denominator automatically will be the word which comes first, that is gross profit. So that is how we compute that. The other profitability ratio is something known as the operating profit margin. Operating profit margin. Equally, you can see the word margin here, meaning that in computing our ratio here, the formula will be, or the denominator will be revenue, and then the numerator will be operating profit. Operating profit. And you have to recall up here, we have said that the operating profit is known as PBIT, profit before interest and what? And tax. So the other profitability ratio, that should be number 4, is the return on equity. The return on equity, ROE, or this is also known as a return on investment. ROE, return on equity or return on investment. This is computed by taking the net income, the net what? The net income. So we take the net income here. Net income, or basically the profit after tax. And then we divide that with equity. Equity times 100. So equity, you have to recall, this is the ordinary share capital and what? Ordinary share capital plus reserves. Ordinary share capital plus reserves. We have the other profitability ratio, which is net profit margin. Net profit margin. And the net profit margin equally, because we have the word margin, our denominator here will be revenue, and then net profit, net profit. So the net profit of the company is the profit after tax, which is also known as net income, which is also known as net income times what? Times 100, times 100. So therefore, these are some of the profitability ratios which may be computed by the company purely to evaluate how the company is performing. And you have said that the company performance will be directly related to the performance of the company's what? Management. So let's move and look on the other category of ratios. Number 2, we have liquidity ratios. Liquidity ratios, and basically liquidity ratios, you have said that these are ratios which are computed to do what? To evaluate the ability of the company to meet the short-term financial obligations as and when they fall due. So majorly here we have like 3 liquidity ratios. The first one is the current ratio, which is also very, very common in the questions in this paper. So current ratio is computed by taking the current assets all over current liabilities. And in this case, it is important to mention here that a recommended, or in other terms, we talk of ideal current ratio should be 2:1. So for the company to be in a position to pay the short-term financial obligations as and when they fall due, the current liabilities must be 2 times of the current what? The current asset must be 2 times of the current liabilities. So then from there we have the quick the quick ratio, which is also known as the acid test ratio. So these are ratio which is computed to determine the ability of the company to pay the short-term debt as and when they fall due using the highly liquid current asset. And basically all the current assets of the company are highly liquid except the inventory. So therefore, to compute the quick or the acid test ratio, we take the current assets minus the inventory. We say inventory is not highly liquid. It cannot be converted into cash within a short period of time. If you have a business and you have some inventory which is lying there in your business, there is no way you'll keep on calling your customers maybe to come and buy the inventory which is there. Inventory is not highly liquid. So we take current asset minus inventory divided by current liabilities. And then finally we have the cash ratio, which is basically a ratio which is computed to determine the ability of the company to pay the short-term financial obligations using cash and cash equivalent. So therefore, in terms of how we compute this, we take cash plus cash equivalents, or basically we can say cash and cash equivalents. Cash and cash equivalents, then divide that with the current liabilities. So when talk about cash here, we are talking of cash in hand, cash at bank, and then cash equivalent. These are short-term investment. Short-term investment, or those particular investment by the company, and which in the statement of financial position are part of the current asset. So therefore, you have those as the various liquidity ratios. Let's move and look on the other category of ratios, number 3, and that is efficiency stroke activity ratios. And I think we have already said that these are ratios which are computed to determine how efficient, how well the company is using now its assets to generate profit. So in this case, we have a number of efficiency, or a number of activity ratios, which include the inventory turnover ratio. This one is computed by taking what? By taking the cost of sales divided by average inventory, divided by average inventory. So the cost of sales, this is something already which will be given to you in the income statement. Average inventory, this one, average inventory, inventory. This one is equal to opening inventory plus closing inventory divided by 2. Opening inventory plus closing inventory divided by 2. Then, and basically this ratio here is a ratio which is computed to measure the frequency of making sales. How the number of times on average the company converted inventory into sales. So then we have inventory turnover in days, inventory turnover in what? In days. Some books can also refer to this as inventory holding period. Inventory holding period is a ratio which is computed to determine the number of days the company takes to make sales. So in terms of how we compute this, we take the average inventory, then we divide all that with the cost of sales times the number of days in a year. Usually you'll be told to use 365 days. 365 days. So the other efficiency or activity ratio number 3 is the trade receivables. Trade receivables turnover. And on the other hand, this is a ratio computed to basically determine the frequency of debtors paying their debts, or in other terms is a ratio which is computed to determine on average the number of times the debtors paid their debt. The higher the number of times, the better. So how do we compute this? We take the credit sales, or basically the credit revenue, we divide that with the average trade receivables. Average trade receivables. That's how we compute the trade receivables turnover. Then next, number 4, we have trade receivables turnover in days. Turnover in days. In other terms, this particular ratio can also be known as the trade receivables correction period. It is a ratio which is computed to determine on average the number of days the customers take for them to pay their debts. The shorter the number of days, the better. So how do we compute this ratio? We take the average trade receivables, we divide that with the credit sales times 365 days. Then the other issue, number 5, we have trade payables turnover. And on the other hand, this is a ratio now which is computed to do what? To measure the frequency of paying the suppliers, or the number of times on average the company paid the suppliers. So in terms of how we compute this, we take what? We take the credit purchases, or the cost of sales. In most of the questions, the examiner will not have given you the credit purchases. So instead we use what? The cost of sales, and then divide that with the average trade payables. And anytime you see average, to compute the average, you take the opening balance plus the closing, divided that with 2. And then we also have the other efficiency or activity ratio, which is the trade payables turnover in days. In other terms, this can also be known as the trade payables payment period. Is a ratio which is computed to determine on average the number of days the company is taking to pay the suppliers or to pay the creditors. So in terms of how we compute this ratio, we take the average trade payables, divided that with the credit purchases times 365 days, 365 what? Days. So therefore we have this as actually some of the efficiency or activity ratios. We have mentioned about what? The inventory turnover in days, the trade receivables turnover. Then we have also talked about the trade receivable turnover in what? In days, trade payables turnover. Then you have also talked about the trade payables turnover in what? In days. And I think we also have another one which is also known, which is known as what? Which is known as the total asset turnover. Total assets turnover, still an efficiency ratio, and this is computed by taking revenue. Remember, revenue is the same with the sales. We divide that with the total assets. So those are the various efficiency or activity ratios which may be computed by a company to evaluate how well the company is using its assets to generate a profit. So let's move and look on the other category of ratios, which is number 4. Number 4, we can look on the capital structure. The capital structure stroke solvency stroke leverage ratios, and we said that these are ratios computed basically to evaluate the ability of the company to pay the long-term debt as and when they fall due. So these ratios, we have a number of them. Number 1, we have the debt to equity ratio. Debt to equity ratio. This one is computed by taking the debt. Debt is all non-current liabilities. We divide that with equity. Times what? Times 100. Then we also have number 2, the interest cover ratio. The interest cover, or basically we can just refer to it as interest coverage ratio. Basically, this is a ratio which is computed to determine on average the number of times the company would have paid the interest using the profit before interest and tax. So therefore, in terms of how we compute this, we take the PBIT, profit before interest and tax, which is also known as the operating profit, and then we divide that with the interest or the finance cost for the year. The interest or finance cost for what? For the year. Let's look on the other ratio, number 3. Number 3, we have a financial leverage ratio. This one is computed by taking the total assets and then we divide that with equity. Equity, always we have to recall that is the share capital plus reserves. And then number 4, we have the debt ratio. Debt ratio, this one is equal to total liabilities all over total assets. So I've said this is total liabilities all over total assets. So this ratio, we express it as a percentage. It shows the relationship between the total liabilities of the company and what? And total asset So basically, those are some of the capital structure or solvency or leverage ratios which are ordinarily computed to evaluate whether the company is in a position to pay the long-term debt as and when they fall due. Finally, I want us to look on the investment stroke equity ratios. And recall, we say that these are ratios computed to help the equity shareholders, that is the ordinary shareholders, in terms of evaluating how well the investment in the company is performing. So we have a number of investment or equity ratios, which include number one, the earnings per share. Earnings per share, this is equal to the profit attributable to ordinary shareholders. This one is abbreviated as per TOS, which is profit attributable to ordinary shareholders. We divide that with the number of ordinary shares. Number of ordinary shares issued by the company. In terms of how we compute or we determine this profit attributable to ordinary shareholders, we take the company's profit after tax, and then to this we less the preference dividend for that year. Preference dividend for that year. Whatever you get here is known as PATOS, the profit attributable to ordinary shareholders. Profit, the company's profit after tax, or the profit for the year, minus the preference dividend for that year. So then from there we have the other ratio, and that is the dividend per share, DPS. This one is equal to total dividend paid. Total dividends paid. We divide that with what? Number of ordinary shares. So this is a ratio which is computed to determine the dividends paid per share. Dividends paid per what? Per share. So that is the other investment or equity ratio. The other one is called the dividend cover. Dividend cover ratio. So this ratio here is computed using the earnings per share and also the DEPS. So we take the earnings per share, we divide that with the DPS. So whatever you get here is known as the dividend cover, the dividend cover. Number 4, we have something called the dividend yield, the dividend yield ratio, dividend yield ratio. So how do we compute this particular ratio? Here we take the dividend per what? Per share, DPS. We divide that with something called the market price per share, abbreviated as MPS, and then times 100. Whatever you get there is known as the dividend yield what? Ratio. And then from there we have the last ratio, which is called the dividend payout ratio. Dividend payout ratio. So how do we compute this one? We take the dividends per share, all over earnings per share, equally times what? Times 100. Times 100. So therefore, those are the various investment, or basically the various equity ratios which are computed by the company to help the shareholders of the company in terms of evaluating how well the investment they have made in the company is actually what? Performing. So therefore, those are some of the ratios which you need to know, and also their formulas, and they may be computed by a company to help the various users in terms of making what? Decisions. So I want us to take a short break. Once we come back in our next session, we're going to look on some illustration question from the CASNEB past papers regarding the ratio analysis, regarding computation of ratios, and regarding something called the common size. So see you in the next session.